Good morning and welcome to Market Sunrise. I'm Ramzan Karmali. Coming up on the show, gold hits a record high as expectations for a rate cut mount. Tesla's global sales rout shows no signs of easing. Trump labels the India trade relationship a disaster as Modi meets China's Xi. And why are AI stocks coming under more pressure to deliver? So grab your coffee and let's own the morning. Our top story today is all about gold. It hit a record high as the prospect of not only more rate cuts, but also concerns over the Fed's independence grow. Spot gold climbed over $3,500 an ounce. That's its highest since Liberation Day back in April. In fact, the precious metal has gained more than 30% this year, making it one of the best performing major commodities of 2025. Looking at gold futures, and the performance is even better. Market sentiment remains heavily influenced by speculation of a Federal Reserve rate cut in September. According to the CME Fed Watch tool, there's currently a 90% probability of a 25 basis point cut. Investor sentiment has been further shaken by growing concerns over the Federal Reserve's independence. Trump has repeatedly criticised Fed Chairman Jerome Powell and recently threatened to dismiss Governor Lisa Cook, leading some to question the central bank's autonomy. The ongoing pressure has raised concerns about the future direction of US monetary policy. On top of all of this, some central banks have been quietly adding to their gold reserves, signalling growing global interest in the asset as a hedge against economic uncertainty. And that's also driven an increased demand for gold-focused exchange-traded funds, or ETFs. Take a look at the biggest ETF in the space, GLD. It too is up over 30% this year alone. Both gold and its cheaper cousin silver have more than doubled over the past 3 years. In fact, this year silver is outperforming gold. It's up around 40%, with prices breaking above $40 an ounce for the first time since 2011. Remember that silver has some key industrial uses in clean energy technologies, like solar panels. One other important factor for gold and silver as well has been the weak dollar. It's made gold even more attractive to foreign buyers. And with mounting risks in the spheres of geopolitics and the economy, it's fair to say right now that it's pretty likely we'll continue to see an increase in demand for the time-honoured haven assets like gold. Well, the first thing you need to know about is all about trade tensions between the US and India. President Trump criticised the tariff and trade relationship with India on Monday, saying it had been heavily one-sided for decades. Well, that outburst came as India Prime Minister Narendra Modi is attending a summit with China and Russia, the SCO summit, to strengthen ties with other BRICS countries as relations with the US have deteriorated. Notably, North Korea is also participating, but Modi is keeping his distance from Kim Jong-un. Trump, in a post on Truth Social, also said that India had offered to cut its tariffs to zero, but it was getting late and that the country should have done so years ago, without elaborating on when such an offer was made. This happens just after the US imposed 50% tariffs on the country, including secondary duties of 25% last month for purchasing Russian oil, which India has called unfair, unjustified and unreasonable. Okay, breaking news now for our second thing to know. And Kraft Heinz is to split into two separate companies after over a decade together. In the breakup, one global company would focus on sauces, spreads and seasonings, while another would sell grocery staples in North America. Its shares are higher in the pre-market, but over the past year, shares have fallen around a fifth. The transaction undoes much of the work done from the much maligned merger of Kraft and Heinz in 2015, a deal arranged by Warren Buffett and Brazilian private equity firm 3G Capital Partners. And the final thing to know about takes us to the world of AI. US tech stocks came under pressure on Friday, driven by concerns about the rapid pace of investment in AI and a series of disappointing earnings reports in the semiconductor sector. Take Nvidia. Last week it fell over 2%, marking its steepest weekly decline since May. Broader weakness in chip makers dragged the Philadelphia Semiconductor Index to its lowest point since mid-April. The tech stock selling could reflect that investors took profits near the month end, especially after a hot August, when technology shares led markets to record levels. Now, not all stocks have climbed at the same pace though. Apple prepares to reveal new products next week. It has often come into focus when it comes to its AI spend and it's not been for the right reasons, to be honest. Many analysts have said it's fallen behind its rivals in the space. Well, Dan Ives at Wedbush says it's not going to be easy to catch up.
I believe it's going to be a big upgrade cycle, and we've talked about it. But the reality is, Apple, they're playing baseball without a shortstop and a catcher. They're missing AI. And there's only one way they're going to do it. It's not from innovation within Cupertino. They're going to have to do an acquisition, where there's Perplexity, as well as doubling down the Gemini partnership. I think that combined with iPhone 17 are the keys to what I view as, a stock going much higher, but they cannot miss this AI boat.
But Apple hasn't really been the buyer of assets, right? So I guess what do you think it would take, or what company would it take for them to really change that mindset?
We think it's Perplexity. I mean, it's clear as day that innovation is not going to be coming at Apple when it comes to AI. And that's why I think they're going to have to do an acquisition. I think the writing's on the wall, and this is the time.
Well, coming up just after a short break, how traders are preparing for this week's jobs report. We'll have a live interview with our special guest, Jane Foley from Rabobank. Welcome back to Market Sunrise. Now, coming up this week, US investors are preparing for the impact of the August jobs report. Well, to help me unpack this story, I'm joined by Jane Foley, who is the head of FX strategy at Rabobank. Jane, thanks so much for joining us here on Market Sunrise. Before we get into the jobs report, later today we get the ISM manufacturing PMI data for the US. What are we looking out for here? Will we see some signs of more strength in the US economy, perhaps?
Well, perhaps not. Now, thank you for having me. But if we look at the ISM today, I think that's in a nutshell going to give us a really good idea about the shape that the US economy is in. Now, most of the activity indices within that, so the employment index, for instance, the overall index, the market is looking for numbers under 50, which means contraction. So you're looking at an economy which is slowing, albeit moderately. But there is one exception to this, the prices paid. So the inflation indicator within this series is expected to be higher. So we've got this combination of sticky price pressures and then, of course, a slowdown in activity, which is not a combination which the Federal Reserve, for instance, will want to see.
Well, let's move on to the main event of the week, I suppose, and that's the August jobs report. What are you looking for here, really?
Well, it's always a difficult one to predict, which of course is why this report is the most exciting one of the month. And it is the report, though, that the market will be looking at, especially because of the Federal Reserve policy meeting in just over 2 weeks' time. Now, this is the report that for many market participants will cement their view as to whether or not the Fed is likely to cut interest rates or not. Now, the market is not quite fully priced for an interest rate cut. This one could tip it to a fully priced or perhaps not. And again, the labour market perhaps is in a state of flux because we do also know that Washington has been making changes with respect to workers and immigrants. And so from that point of view, it's possible that there's going to be a smaller workforce, and that should help keep the unemployment rate down, irrespective perhaps of some of the more headline figures that we're looking at.
So how does this tie up with what you said earlier about inflation and a tighter job market? How will that impact on the Fed? Is there any chance that they won't cut rates at all?
Well, I mean, it does appear that they probably will, and certainly Rabobank is forecasting that they will. But what could put a spanner in the works would be signs of inflation. Now, as I mentioned, the prices paid index of the ISM index today is likely to show that there is sticky inflation pressures. The wage data in Friday's report will also be watched, but most people are looking at the overall health of the labour market, signs of loosening. And don't forget that, the labour market, as well as inflation, is part of the Fed's dual mandate. So generally speaking, if we do get a slow increase in jobs creation, that's probably going to make the market decide that there is enough room there for the Federal Reserve to cut interest rates this month.
And going forward, the independence of the Federal Reserve, that's really come into question in recent days. What's your take on that? Does it really matter if the president gets his people, his so-called people, in the Federal Reserve, if the economy doesn't really behave like he wants it to?
We've got to remember that the economists, the people that Trump is talking about putting in, or maybe put into the Federal Reserve over the course of the next 6, 7, 8 months or so, are generally credible economists. Now, that is perhaps why the market hasn't seen this yet as a particularly negative factor, because although we all know that Trump would like the FOMC to cut interest rates, then the economists that he is backing or could be backed, the names that we have, or the names that are in the hat, are all people with very strong reputations, and that would probably imply that even if inflation did get out of hand, if there was a significant inflation risk, even though those people may be doves right now, there's nothing to say that they wouldn't do the sensible thing on policy and keep rates on hold. So for now, a lot of people agree with Trump that rates should be lower. That also is meaning that Fed independence is perhaps not become a massive market factor. It's only if the FOMC were seen to be cutting interest rates in the face of strong inflation, I think that the market would really worry.
And Jane, it would be remiss of me not to ask you about the US dollar, being an FX strategist. What do you make of the recent weakness that you've seen, and how could that impact?
Well, it is quite interesting. In fact, the dollar is the strongest performing G10 currency over the last 24 hours or so. We've seen a little bit of a comeback. And in fact, if we look at euro dollar, it's been in a range for the last 2 months, although the dollar is still the weakest G10 performing currency in the year to date. Now, a lot of that weakness was around the spring, around the time when the market was expecting perhaps recession in the US. Those fears have abated. There was a lot of hedging activity as hedging ratios were pushed higher again this spring. That weakened the dollar. That activity may have come to the end of its course now too. So I think we could see a more consolidative phase for the dollar opening up over the next few weeks and next few months, irrespective of perhaps a knee-jerk reaction after the payrolls report.
Jane Foley from Rabobank, many thanks for being here on Market Sunrise. And there's one more thing you need to know about jobs. Beyond the report coming out this week, analysts have been looking at the long-term implications of the jobs market. And one big trend that's emerged is how immigration policies are going to affect the labour force. Wendy Edelberg, Senior Research Fellow at the Brookings Institute, explains why a shrinking workforce may not necessarily coincide with a recession.
Whether it's 150,000, 100,000, 50,000, those numbers are pretty meaningless without knowing what we should compare them to. What's a healthy number? So 150,000 in an economy that has a booming labor force because of, let's say, booming population growth and booming immigration, 150,000 may well be a very weak number that alarms policymakers and makes them think that the labor market is much too soft. You need a point of comparison. And right now, we probably have very weak labor force growth. And so what that means is that the point of comparison is a number that might be as low as 10,000 a month. And in fact, I think we're on track next year, the year after, to actually have a shrinking labor force month after month. And that means in a healthy labor market with a low unemployment rate and nice wage growth, we're going to see the first Friday of every month actually negative payroll growth. And that won't mean that we're going into recession. That will simply mean that we have a shrinking labor force. And, that's the policy we've chosen. If you want like a sense of how this could play out in a strong, rich economy, think about Japan. In Japan, population growth is slowing, labor force growth is slowing, and month after month, they see negative payroll employment. And that doesn't mean they're going into recession. That just means that's what their demographics look like.
Okay, we're going to be heading now for a short break, but stay with us on Market Sunrise for Trending Tickers. Welcome back to Market Sunrise. Well, let's start with our trending tickers. And first up, Alibaba, the Chinese e-commerce giant that's now also positioning itself as a major player in the artificial intelligence space, posted a 19% surge on Friday, its biggest jump in 3 years. And this morning, it seems to be giving up some of those gains in Hong Kong. It's now down around 1.75%, as you can see but in New York, it's actually higher, about up 1.5%. Investors piled into the AI plus cloud story in its latest earnings. Cloud revenue grew 26% year on year, while AI-related product sales kept up triple-digit growth. Today, we might see some profit taking, especially from investors in the US. Keep in mind, the stock is basically back to where it was 6 months ago. Brokerage reaction around the world has been bullish. HSBC, UBS and Jefferies lifted price targets above $160. Alibaba CEO Eddie Wu says AI plus cloud alongside e-commerce are the two core growth engines. So the question for today is whether that AI flywheel can keep sentiment elevated into the US session. Okay, now from China, we are moving on to Switzerland, to be precise. Nestlé, the maker of Nescafe, Kit Kat and Purina, is under pressure after a leadership shock. The stock is, well, fairly stable for now, as you can see there, down just under 1%. But the packaged foods multinational company is going through a storm. The board dismissed CEO Laurent Frechet with immediate effect over an undisclosed romantic relationship with a subordinate, a code of conduct breach. And now the head of Nespresso, Philippe Navratil, is taking over as CEO. Shares initially slipped as investors weighed governance stability and execution risk. Now, as you just saw in this chart, Nestlé shares have already had a difficult 6-month ride. We'll be watching for strategy signals from Navratil and see how investors will react to this new uncertainty. Okay, let's head to our third ticker, and it is ahead of the Wall Street opening bell. Tesla is wobbly on mixed international sales. Since launching in India in mid-July, Tesla has received, listen to this, just over 600 orders, well below internal expectations. That's according to Bloomberg reports. The Tesla stock is only slightly in the red this morning after closing 3.5% down on Friday, ahead of the long weekend. In Europe, Tesla sales, well, the rout continues. Listen to this. France, minus 47.3% year on year in August. Sweden, minus 84%. Denmark, minus 42%. And these are just the latest numbers after a string of weak sales results in Europe this summer. And look at how the stock has been struggling this year. What's behind the rout? Of course, competition from China's BYD, the rising star in the global EV market. But Tesla is also suffering from softer brand momentum as Elon Musk continues to express controversial opinions, and other headwinds such as global trade uncertainty over tariffs. Watch the open to see if US flows absorb the negative sales headlines or if we see more pressure on Tesla. Speaking of that trade uncertainty among the sectors that have been most vocal about tariffs, you may have heard that retailers, and specifically apparel retailers, have been particularly badly hit. At the end of last week, Gap reported missing sales expectations and issued a stark warning that tariffs will hit profits. My colleague Ali Kanal interviewed Miller Drexler, chairman of Alex Mill and former CEO of Gap. He explained how apparel retailers are handling the pressure in the current environment.
Well, there's a multiple choice here because I think we're all flying blind. We don't know yet what's going to be, but it's not going to be easy. That you can't control the controllables right now. You don't know what the cost of your goods are relative to retailing and margin. And we sit with pins and needles, for example, on China, which is America's factories, a lot in China, needless to say, and a lot of people are using China for their manufacturing, even small little parts. So I think we haven't seen the worst of it at all. But I know as much as anyone else knows, not that much.
Right, and if you can't control the controllables as a leader of a retailer, what can you control?
Well, the one thing long term, you can control your product, and the goods are always number one. And Alex Milnow is kind of having a nice moment. I'm liking very much. I don't get too, I'm superstitious, but it's about the merchandise. And it's not about having algorithms. It's not about the data. It's about what you do with the data. How do you see down the street? What's the message from the consumer? Mm-hmm. And that's what will make it best. And I'm not a discounter brain. I think discounting is doing very well from what I hear, except with always exceptions. Mm-hmm. And I think the tariffs, they're hurtful.
Finally, here's our call of the day. Evercore ISI is making a striking prediction. AI euphoria could propel the S&P 500 to new highs, another 20% higher by the end of 2026. Evercore's chief equity strategist Julian Emmanuel sees the index climbing to 7,750 points, outpacing virtually every Wall Street forecast. He frames today's AI boom as a once-in-a-lifetime opportunity, likened to the internet revolution, but with broader growth from sectors like utilities and industrials, not just tech giants. Evercore points to Q2's double-digit earnings surprises as proof that AI continues to deliver, even amid trade tensions. Names like Nvidia, Meta and Microsoft are up over 20% this year, heavily boosting the index performance. While the base case targets 7,750, the bull scenario for Evercore sees the index hitting as high as 9,000 if confidence accelerates across the board. On the other hand, a bear outcome to 5,000 is possible if inflation remains sticky and growth falters. Evercore also updated its near-term outlook, raising its 2025 year-end forecast to 6,250, so that's pretty conservative. Bottom line, if AI continues to support this exuberance, things can still climb much higher from here. But there's plenty of reasons to be cautious, as many other analysts keep reminding us. Okay, before we go, let's have a very quick look at the futures market in the US. And a bit of a negative start to the day. A lot of caution ahead of this important week for the jobs market. Okay, well, that's all we have time for on Market Sunrise. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up today, we'll have much more coverage of the so-called September effect, as well as NEO and the electric vehicle race. I'm Ramzan Karmali. Go own the morning.